Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts, the all-in-one platform for investment research, client communication, and proposal generation, built specifically for today's advisors. With time-saving features like AI chat, quick extract, and customizable proposals, YCharts brings everything into one place so you can stop juggling software and focus on what matters most, your clients and growing your business. In 2024, advisors using YCharts added an average of $33 million in new AUM, all while saving 20 hours a month on research, proposals, and meeting prep. That's basically half a work week back in your pocket. That's why 9 out of 10 advisors rate YCharts above average or best in class for ease of use, data depth, and overall effectiveness. And when it comes to service, users give YCharts 4.5 out of 5 stars for their white glove support. No bots, just real support experts ready to help whenever you need it. Whether you're growing your book, sharpening your process, or deepening client trust, YCharts is the platform to get it done. See for yourself and get 20% off your initial YCharts professional subscription when you start your free YCharts trial, and tell them that Meb sent you for new customers only. Welcome back, everybody. Today is a special episode. We got 2 many-time returning guests, my favorite duo. We got Rob Arnott and Professor Cam Harvey. Rob is the founder, chairman of Research Affiliates. Cam leads Strategic Research Affiliates. Also a Dookie, professor of finance at Duke. Rob and Cam, welcome back to the show.
Glad to be here.
Great to be here.
I thought I'd try something different because of the new age we're in now, which is I trained up some AI custom GPTs, and I said, let's let you guys ask Rob and Cam a question. So I'm going to read my first question, which was from a sentient being online. They tailored this one to Rob. So Mr. GPT says, your research often challenges mainstream narratives, particularly around market efficiency and the dominance cap-weighted indexing, giving the surge in passive investing, which I think Cam just had a little article on, and the crowding into safe megacaps. Do you see this as sowing the seeds for a new value opportunity? Are we looking at a structural shift in how markets allocate capital? What do you think, Rob?
I think the flow of money into indexation is, at least on an intermediate horizon of a decade or more, inexorable. It's going to continue. And it is massively disruptive. It drives a valuation wedge between index members and non-members relative to their underlying fundamentals. That is to say, these stocks are worth about 80% more than the non-members, adjusted for relative growth rates, which is fascinating. That means these stocks are going to produce higher internal rates of return, but we've got a draft paper, Membership Has Its Privileges, which talks about the one privilege of being added to the lead indexes is that you're entitled to a premium multiple. The other privilege is that as money pours in, that spread can widen. Now, if the non-members have an IRR over the next 30 years that's higher because their pricing is lower relative to fundamentals, that's all well and good. But if the spread widens, that can overcome that IRR difference for a while. It's a long answer to a very short question. The short question, does this sow seeds for a value recovery? Absolutely. On a 10-year horizon, I would happily bet my life savings that value will beat growth over the coming decade. In fact, I do bet my life savings on that. And that's all well and good. Will it happen this year? Who knows? Next year? Who knows? On a 10-year horizon, I'd have 80-20 odds on that.
Let me take a stab at this question, which is a good one. And I have thought about this pretty deeply. And there's this really important paper published in 2005. And it's got the following intuition. So if you think about what we learn in Finance 101, we learned the capital asset pricing model. And the implication of that model is that you should hold the market portfolio, and depending on your risk aversion, you lever it up or lever it down. And this led to an explosion of passive index-like investing. So this paper in 2005 had the following insight, and that is that one crucial assumption in the Sharpe model is that prices are always exactly correct. So the market is hyper efficient at every point in time. And of course, if you've got a situation like that, then you should hold the market portfolio. There's no need for price discovery because all the prices are exactly correct. So this paper says, well, if there's any deviation from this hyper market efficiency, then a cap weighted portfolio will mechanically overweight overvalued stocks and underweight undervalued stocks. You don't even need to identify which ones are which. This is just mechanics. And that paper is authored by Rob Arnott. And
Gosh, I thought you might be alluding to that paper.
and it is like a significant insight. So this is kind of the underpinning of my recent work on passive aggressive, we call it, that when there's so much money that goes into passive, then there isn't the same force for price discovery. So people are just buying based upon market capitalization. They're not looking at fundamentals whatsoever. And that damages market efficiency. It's also the case that other things are damaged. For example, when these orders come in for essentially the market, it increases the correlation between stocks. This decreases diversification ability and indeed heightens systemic risk. So in a sell-off, like everything is dumped simultaneously. So I do think that we are moving in a direction that's dangerous. And a lot of it is based upon this misinformation that, the best you can do is to hold the market portfolio.
There's a couple of other nuances here that I think bear mention. Firstly, for those of your viewers who haven't seen the paper Cam was alluding to, brilliant title, Cam, Passive Aggressive. But passive aggressive is just a beautiful capturing of what goes on in the flood of money into indexation. Price discovery gets pushed to back burner. Capital formation becomes relative opportunity indifferent. You have a valuation indifferent buyer who owns half of the stock market, who doesn't care what any asset is priced at. And another missing component is capital asset pricing model presumes that the market clearing portfolio is the mean variance efficient choice if it's the full market portfolio. S&P 500 isn't the full market portfolio. Russell 1000 isn't the full market portfolio. A U.S. aggregate spanning all 4,000 publicly traded U.S. companies is not the market spanning portfolio. It would have to be a global portfolio. It would have to span stocks, bonds, and other liquid assets. And it arguably should include illiquid assets like human capital. So in point of fact, the market index portfolio is unachievable. It doesn't exist.
I was just trying to think in my head how you're going to include human capital. I remember asking Professor Sharpe, I said, Cam, I think you'll like this. I said, Professor Sharpe, what role does Bitcoin play a role in the global market portfolio? And he paused and he smiled and he said, yes, but not a positive one. So I thought that was great. I feel like everyone's kind of talking about the situation. So this is the prescription. What's the diagnosis? What do we do about it? Is this something we just kind of acknowledge and move on about our day? Or is this something we say, okay, well, now that we know that this is the base case and the setup, I should allocate my portfolio differently? What do y'all think?
It is interesting. I was recently at a conference at the University of Chicago, and in the audience, people like Eugene Fama, where I'm making the case that the market might be less efficient today than it was 20 years ago. And if you think about the fundamental forces behind this move towards inefficiency, number one, and it's paradoxical because transactions costs have come down dramatically. So you would think, oh, well, transactions costs have come down. That means the market should be more efficient. But there's a countervailing force, and that is with these transactions costs coming down and then fractionalization of shares and things like that, it just invites the retail trader to the table. So we have seen a dramatic growth in the proportion of total trading by retail investors. And retail investors do not have access to the type of information that large institutional investors have. So the amount of price discovery that they're actually contributing to is minor, and many people would argue that it's a negative force. So you put that together with the growth in indexation and passive investing, which again, it doesn't matter what the fundamentals are. You're just buying by market capitalization. You put those two things together and the market becomes less efficient. So what does this mean? Well, it means that there are potentially increasing opportunities for active investing. And of course, we've seen the performance of active investing relative to passive is not that impressive in the past. But of course, investors, what they care about is not what happened in the past. It's what will happen in the future. And there's a strong case that can be made that active investing is going into a period where the payoffs could be very handsome.
I would offer a cautionary note on that, and that is that it goes back to Sharpe's famous paper, The Arithmetic of Active Management, in which he postulated that the market is the cap-weighted index. The cap-weighted index funds are part of that. Take them out and you're left with the same portfolio. That's what active managers own. That's going to, by definition, offer the same collective return minus trading costs, minus fees that are higher. Therefore, active management can't win. That case makes perfect sense if the index funds span the full market, which they don't. But what I find just remarkable, people pay a lot of attention these days to the spread in valuation between growth and value. And our classic Fama French book-to-market basis, the spread in valuation between growth and value was 3-to-1 in 2007. Sounds like a big spread. It's not. It's a historically narrow spread. Widened to 9-to-1 in 2020 and is currently hovering at 8-to-1. 8-to-1, huge spread. But what gets less attention is small cap versus large cap. If you look at small cap versus large cap based on a blend of relative price to sales ratio, relative price to cash flow, relative price to dividends plus buybacks, very common sense relative valuation multiples, large cap is now priced at a 150% premium to small cap for the first time in U.S. stock market history. I mean, we've all heard about Apple and Microsoft being individually worth more than the entire Russell 2000. Well, intuitively, that doesn't make a whole lot of sense. But when you drill down and look at the underlying fundamentals, you find that those top 1,000 are priced at 150% premium relative to the underlying fundamentals when compared with small cap. That sounds to me like a prima facie case for a 10-year horizon in which small cap value could easily beat large cap growth by 1,000 basis points a year over the next decade.
That's a number, listeners, 1,000 basis points. It's funny because up from 2009 till really end of year last year, S&P stomped everything. Market cap weight just about crushed just about everything. And small caps still can't catch a break. This year, U.S. market cap's not doing much, but small cap's doing worse. But on the horizon, we do have a resurgence in foreign and emerging markets, which I don't even remember the last time I've been able to say that. And you have some of these, in particular, some of the value companies in or countries and sectors have really rebounded. Momentary outperformance here, or is this something that is also has got a potential setup for a decade-long horizon?
Well, Having been somebody rather vocal on non-US stocks versus US and non-US value versus US growth in recent years, the reaction in the marketplace is, of course, well, a stopped watch is right twice a day. And gosh, Rob, you were right for a second time in the last couple of years. Very, very fair critique. But the simple fact is the relative valuations are hugely in favor of the non-US value stocks, especially emerging markets value. And when you go back historically, whenever something that is wildly out of favor starts to rebound, the natural reaction is to chalk it up to luck. But in point of fact, these assets are cheap. I've rarely in my career seen as big a spread between assets that are beloved, popular, frothy, expensive, and a whole sweep of assets that are very sensibly priced. I've been called a perma bear, but I'm not a bear when things are cheap, and there's a lot of cheap stuff out there.
So let me comment on that and push back a little bit. So there's a reason that some of these stocks and some of these markets are cheap, and that's because of risk. So we know when risk is higher, that impacts valuation and that investors require a higher rate, higher expected rate of return. So I think that some of this quote unquote cheapness can be accounted for by macroeconomic risk, which might be country specific or actually kind of global. And let me give you like two things that are playing out right now that have increased the risks for emerging markets. So number one, we're in a period of uncertainty in terms of what will happen with global trade. So trade deals are being renegotiated. In the bad scenario, there's a lot less trade. And many of these countries are hugely dependent upon trade with developed markets, in particular the US. Remarkably, I asked my students this question of kind of like 179 countries in the world report GDP and the components. And if we look at trade intensity and define it as exports plus imports divided by GDP, in that list of 179, where does the US place? Well, everybody gets it wrong because the US is 177.
I was going to guess 170 something.
Yeah, it's above South Sudan. But if you go up that list, you see these countries are hugely exposed to trade. So, like, for example, in the US, exports are only 11% of our GDP. In other countries, it's much higher proportion. So that means risk. It's a direct risk exposure. And given the uncertainty in terms of what's happening with tariff policy, it causes a reason for the valuations to actually drop. And let me mention a second factor, which has nothing to do with tariffs, and it has to do with technology. So many of these emerging markets are able to trade with developed markets because labor is cheap. So there's a reason that clothing is produced in Vietnam, because the cost of labor is so cheap compared to the US. However, we are rapidly moving into a world where technology is replacing sort of labor tasks that are kind of mechanical, like clothing manufacturing. So in the future, there'll be no reason to contract out to Vietnam to actually produce T-shirts and caps and stuff like that. We can do it at home with robots that cost $1 an hour, that work 24/7 and don't go on strike. So all of this just increases the risk. If you look at any equity, it's obviously the value discounted of the future cash flows. So you put these two things together, and I think that it explains some of the difference in valuation. I have no doubt in terms of what Rob is saying, that there are some extraordinary deals out there, but we need to be careful to kind of strip out the risk component.
Exactly. So one of the things that I think is just fascinating is prices are set based on narratives, and those narratives have the advantage of being largely true. Most narratives are mostly true. They have the disadvantage of being entirely reflected in current share prices. So what you're describing is the narrative that drove relative valuations for emerging markets lower. And then the question is, how much of that narrative is correct? Most of it. Where might it be wrong? When I look at narratives that are shaping the pricing in assets, one of the things I observe again and again is that they shape markets slower than people expect. The narrative is correct, but the time horizon is more gradual. That may or may not be true. You're right. AI-driven clothing manufacturing could turn South Carolina and North Carolina into the clothing manufacturing mecca that they once were. But by the same token, it might take a decade. And that kind of thing tends not to appear in the narrative. The narrative that AI is going to radically reshape our world, that the Magnificent Seven truly are magnificent, that they're massively profitable, that they're building a brand new world for us all, is absolutely true. Will the world of 2027 be radically different from the world of 2025? Count me as a skeptic. Will the world of 2035 be radically different from 2025? Oh my God, yes. The other piece that tends to be missing is that disruptors get disrupted. And we see that again and again. DeepSeek came out of absolutely nowhere. Poof, suddenly OpenAI is getting disrupted. OpenAI, more and more people are discovering, as both you and I have, that AI makes a much better search engine than Google does. You don't get pop-ups. You don't get sponsored links. You get a roster of useful links and an AI summary of what you're looking for, which 9 times out of 10 is more useful. Well, talk about Google getting disrupted. Google's now rolling out its own AI search engine to disrupt itself, because it would rather disrupt itself with a lower revenue, lower profit version of search engine that it controls rather than being disrupted by third parties. So the winners of 10 years hence often aren't the winners of today. So that's another part of the narrative that tends to be missing. I think it's fascinating, going back to the emerging markets issue. Roll the clock back to early 2008. The narrative was emerging markets are growing faster, their profit margins are higher, therefore they should command a premium multiple to the U.S. Before the global financial crisis, U.S. stocks peaked at 28 Shiller PE ratio. Emerging markets peaked at 38. Wow. And then roll the clock forward to today, U.S. is at 34, a substantial premium to the top before the GFC. And emerging markets are at about 15, up from about 13 a few months ago. So emerging markets are half off instead of a 40% premium. What changed? The narrative. The underlying fundamentals, the underlying reality has evolved in ways that we both are very familiar with. But what's really changed is the narrative, the projection higher, ever higher on EM profits relative to rest of world versus now projections of profit headwinds for EM, all based on narratives that are largely correct, but entirely reflected in current share prices. So then the question I love to come back to is what's not reflected in current share prices. I'll pass the baton on that little hot potato back to you, Cam.
Yeah, so a number of things I want to comment on. The first, you mentioned that often we kind of overestimate in terms of the adoption of like an important innovation. And historically, that is definitely the case. But it's also interesting to look at all of the great innovations historically, and you see a pattern. And the pattern is that the innovation is adopted faster and faster and faster through time. So for me, I agree with you that comparing 2025 and 2027, yeah, there'll be some changes. Obviously, will they be existential? No. But we need to take into account that the speed of innovation has increased dramatically. And I would not want to be betting against the AI, given that what
Oh my
the
goodness,
pace that
no.
we've seen. There's just like no way.
It is astounding. Just for the benefit of your viewers, our CEO, Chris Brightman, carves out 3 or 4 hours every weekend to converse with AI and explore some of its capabilities to try to stress test it. And Cam and I were both blown away about 3 months ago. He entered into a dialogue with AI about how AI fits in the history of human evolution. And it was just fascinating. You'd think it was written by somebody who was a dual PhD in anthropology and philosophy. It was articulate, powerfully worded, and a little scary. It said, this is a new evolution of humankind, and we can merge human intellect with AI in the years ahead. Or AI could supplant human capabilities in the years ahead. And the jarring closing sentence was, what's wonderful is we get to decide. And I was thinking, okay, who's we?
Exactly. So now that we're on this subject, I've been playing with hyper-realistic avatars. So we think of an avatar as like a cartoon. No. So it looks exactly like me. It's trained on video of me speaking. And what I can do with that is to give the avatar some text, and then a video is produced with my voice and with my gestures, my eye movements, and I can have that translated into 175 different languages. And the translation actually is done so that if you're looking at my lips, you will swear that I'm talking Mandarin or Japanese. So this is amazing.
I think the one of you talking Swahili was particularly powerful.
Yeah. So we need to be careful as investors in terms of what industries will be disrupted, what industries can benefit from this technology. So I do think that just using kind of historical perspectives, we need to be careful on that at a time of deep structural change.
It's going to get real weird real quick. I had a quote in Barron's this weekend where they were talking about this Invest America idea. And I said, I put my son's entire 529 into ex-US stocks. Now, I said I do that for somewhat of a barbell reason. One is he's only 8. So in 10 years, he may not be going to university. I was like, maybe they just have like student housing where you go to football games and drink beer, but then classes are in the cloud and it's like, one giant, everyone gets to attend Cam's class at Duke or something. I don't know. And I said, or maybe foreign stocks will just continue to underperform, in which case, buddy, you're going to community college.
Or Cam's class at CAMU.
Yeah, that's right. That's right. So this is probably a good lead in. Rob, you like talking quite a bit about historical comparisons. One piece you did recently was talking about AI boom. And we all agree that it's going to be super impactful and super interesting and super weird and exciting, but at the same time, trying to tease out the investment opportunities and dangers. And you did a little comparison versus .com bubble, which was my favorite.
Yep.
But you go, have we seen this movie before? So give us the overview.
Sure. Very, very simple. 2025 to me resembles the year 2000. You have a small cohort of companies priced at lofty multiples, in some ways not nearly as crazy as the dot-com bubble. And you don't have poster child versions of lunacy like pets.com. And these companies are growing fast and they are massively profitable, but disruptors will get disrupted. Just to take one example, NVIDIA is a phenomenal company. Jensen Huang was brilliant in the decision about 5 or 6 years ago on making their early super chips. He said, let's leave some real estate empty. Let's not fill it with silicon chip power, because we can use that real estate more intelligently a year from now, 2 years from now. That set the stage for the super chips that gave them what was perceived to be insuperable moat. And what a stroke of absolute genius that was. But roll the clock forward 10 years. Is a business with a 50% profit margin likely to attract competition? Oh, you betcha. Is that competition going to come from Taiwan Semi, which makes the super chips for NVIDIA, deciding to compete with their client? Possible. And the list goes on and on. There's a lot of companies capable of doing what NVIDIA is doing with a relatively short lead of 2 to 4 years. And so I think we could project with confidence that on a 10-year horizon, demand for super chips will soar, that pricing power will diminish, that market share for NVIDIA will diminish. You can't have 90+% market share forever. And the net result is you plug some very sensible and reasonable assumptions into a spreadsheet, and you can easily project NVIDIA profits in 2035 being about the same as they are in 2025. Okay, is the market priced for that? Of course not. And so the role of competition, just a natural element of any healthy capitalist economy, the role of competition in reshaping the landscape is underestimated. And so I look at today's market and I say the Magnificent Seven are priced for perfection or something fairly close to that. And some of them will achieve that. Some of them won't. I like to joke that whoever coined the expression Magnificent Seven never saw the movie. 4 of the 7 are dead at the end of the movie. I don't know which of the 7 are going to be dead or are going to be a shadow of their former selves 10 years from now, but it might be 2 of them, it might be 4 of them, who knows, that failed to measure up to expectations. Meanwhile, you have this vast spectrum of assets out there, priced cheap relative to underlying fundamentals, where the profit margins aren't so lofty that they attract competition, but rather you have the opportunity to create pricing power and to create growth in margins, even as your underlying business grows. There's a lot of just mainstream businesses that fall in that category. So I look on today as being very reminiscent of the bubble of 2000. How it'll play out is anybody's guess, but interesting lessons come out of 2000. NASDAQ, the bubble burst more or less March of 2000. Roll the clock forward 2 years to March of 2002. NASDAQ was down 50% on its way to being down 78% at the bottom. S&P was down 27% on its way to a 46% drop. And Russell 1000 value was down 4% in those first 2 years of the bear market. Russell 2000 was up 3%. Russell 2000 value was up 53%. If you had the prescience to pivot from NASDAQ into Russell 2000 value in March of 2000, then you wound up being 3 times as wealthy as if you'd stayed put in just 2 years. So the notion that bear markets take no prisoners is a dangerous oversimplification. If you have left out segments of the market, left for dead, dirt cheap, they can shrug off a bear market. And in fact, we see that again and again in past bear markets. There are segments that in fact did just fine. REITs in the aftermath of the 2000 bubble bursting did beautifully over that next couple of years. And I remember a major university coming to me saying, we want to get out of REITs and out of this and out of that because sure, it's got a 9% yield, but 9% with no growth and no growth potential. And I remember talking our company, First Quadrant at the time, out of an account by saying, you don't want to do that.
I think REITs and gold have outperformed stocks this century. I would have to check my math, but they've both been pretty good performers the last 25 years. Obviously, you're picking a tough starting point with 2000, but just to give you guys a sentiment indicator, when I graduated Virginia in the spring of 2000, our commencement speaker was the president of the NASDAQ.
Oh,
So I don't.
Yeah, that's interesting. What Rob said, I agree with. However, I'm not as enthusiastic about the comparison of 2000 and 2025. And let me give you my reasons. We need to look at the differences. And the differences are pretty stark to me between today and in 2000. So one thing is that, and Rob, you mentioned NVIDIA and the lead that it's got, which is very substantial. And of course, competition eventually will reduce that margin. I 100% agree upon that. But the runway is long, and it's long for multiple reasons. So one reason is that it's not so easy to set up a chip foundry, and it requires enormous capital. And this is different than some of the companies in 2000, where there wasn't this barrier to entry in terms of the amount of capital and also the IP. So the IP is very special in terms of, for example, the B200 chip. This is not something that you just build a factory and produce. It's not so easy to deconstruct. That's number one point. The barriers to entry are very significant today versus in the past. Number 2 point, I think, is even more important, that these companies realize that they will be under the pressure of disruption. And what they're doing is plowing an enormous amount into research and development. So effectively, disrupting themselves. You mentioned Google and Gemini. That's an example where you are basically disrupting your search business, which is incredibly profitable with AI. If you don't do it, if you're not the first one, if you don't retain that share, you're going to be a loser. Tesla is another interesting case where it's unlikely in 10 years that they will be like an EV company. They're heavily investing. They believe that the future is robotics. So they're going to be a robot company, and their cars are just one kind of robot. So again, they're anticipating, given the margins that they've got, they're not doling all this money out to shareholders. They are investing for the future. So I believe this expands the runway. And I think that this is a fundamental difference between 2025 and 2000.
One of the cool parts I think about as you think about this from the investor standpoint, looking back to 2000, a lot of the big companies actually perform well. And I think Rob actually talks about this a little bit in the article, where you have someone like a Cisco. The business actually did just fine and it grew. And then looking at some of the actual stocks was a different story, where you got to the valuation relative to the actual underlying company. And that's a story as old as time, trying to make the differentiation between the underlying business and whether it's even good or bad. It could be a crappy business, the old cigar butts from Ben Grant's time, but the pricing relative to, the expectations, which is what you guys have talked a lot about so far.
Well, Cisco's an interesting example. Chambers back in 2000 was quoted saying, "I don't see any reason we can't grow 40% a year for the foreseeable future." Well, that would be six-fold growth in 5 years. How have they done since 2000? They've had six-fold growth in 25 years, not 5 years. That's 8% a year instead of 40% a year. 8% a year is very, very nice for a quarter century. That's terrific. Qualcomm, even more so, has seen profits grow 60-fold in the last quarter century, but they came into the year 2000 priced at 280 times earnings. So 280 times earnings, you've had profits grow 60-fold. That means they were priced in the year 2000 at about 4 or 5 times today's earnings. Now, there's also been dilution along the way, and because they did share issuances to fund some of their R&D and growth. But be that as it may, that's a stock where it's been a quarter century and you still are waiting to see a performance above that of the S&P. Cisco, you're still waiting to see performance above zero. Their performance is slightly negative. And these are survivors and winners. Then you have companies like Palm, the ubiquitous Palm Pilot of 1999 and 2000. Within 3 years, BlackBerry had totally demolished their market share. And within 5 years after that, Apple came along and just blew BlackBerry out of the water. So innovation and disruption are very healthy, very wonderful attributes of a successful capitalist economy. But it does mean, as Cam was saying, that companies like Google had better be prepared to disrupt themselves, to blow up their own most profitable profit engine in order to not be disrupted by third parties.
Yeah, this is the innovator's dilemma, of course.
Yes, it is. We see it ourselves with Rafi and the so-called smart beta.
Sure. So it is basically a matter of kind of the management skill that you need to be able to make these decisions to potentially, in the short term, substantially give up profitability for the long-term payoff. And it's very hard to do. And often there are kind of short-term pressures that management feel that they need to make the earnings expectation for the quarterly call. And there's unwillingness to take the risk of betting on the future. And then you've got another mindset where you've got these firms that have done very well in terms of innovation and get it. They know that they're going to be disrupted. So why let somebody else disrupt when we can do it ourselves and create value for our shareholders? So I do think that there has been a change in perspective, and it's very healthy to be thinking of the long term. And of course, this is a huge edge for the U.S., where the U.S., the spending on R&D is, indeed, some of my colleagues complain that R&D spending has gone down through time. But on a relative basis, it's a huge difference between, let's say, the R&D spending that happens in the EU versus the US. So we spend way more than the EU, even though the EU's got like more people. And what's the result? Well, the result, if you look at the top valued firms in the world, they're out of the US, not the EU. So I do think that this idea of taking risk and taking long-term risk is something that I think has evolved through time. People have learned the lesson, and it's more likely that we get these strategic long-term investments now, at least in the tech industry in the US.
Well, you and I were both at a meeting not too long ago, Chatham House rules, so I can't specify who it was, but there was a woman who was one of the leaders in French government from the left side. And she was remarking that France needs to build its own cloud capabilities and can do so and will do so. What's she thinking? The bureaucrats are going to develop a better cloud than the U.S. The U.S. exceptionalism, I think, is very real. And in part, as much as a libertarian, I decry our current levels of spending, they're still dwarfed by the spending in Japan and Europe, where industrial policy is considered de rigueur and the right way to deal with things. Pardon me, but industrial policy set at the national policy level is unlikely to be remotely as intelligent or path-breaking or innovative as industrial policy set based on companies seeking to maximize shareholder wealth through their own innovation. You don't succeed in a healthy capitalist system without creating products that are worth more to your clients than they are paying you. Otherwise, the products wouldn't sell.
So, Rob, let me agree with you and disagree with you.
By the way, just as an aside, one of the things that's fun in my relationship with Cam is that we learn best when we encounter disagreement from people whose intellects we respect.
So what I agree with is this idea of France and embarking on a cloud computing initiative that might have made sense 15 years ago.
Exactly.
Or they're going to invest in 3D printing. Well, again, maybe 10 years ago, But today it makes no sense. And it just shows that many of the policymakers and the people that support them within various government bureaucracies just are not up with the latest technology. And I understand it's kind of a hard job to keep up, but still, these are not the people that should be making strategic decisions in terms of where the government is going to place some bets. So the disagreement part is subtle, and it's not 100% disagreement. I do want to give a counterexample of where industrial policy has been very successful, and that's in China. So you already mentioned DeepSeek. China has had an initiative where they want to be the world leader in EV and battery technology. They want to be the world leader in AI. So they have placed their bets, and not all of these bets have turned out. So the commercial real estate is an example of a bet that didn't turn out, but they have a very long-term vision. And I would argue that you just can't say that all industrial policy doesn't work, because that, I think, is a very powerful counterexample. Now, I earlier remarked that I was encouraged that some of the tech firms in the US have a longer term perspective, and that's good. The problem is, in the US, most companies have very short term perspective, and that's not good.
5 years is ultra long term for US businesses, and China does have a vision for where they want to be a quarter century from now, which is the dominant world leader.
Exactly. So it's even longer term. So I guess what I'm saying is that it is possible to make some strategic bets. You need to make those bets in kind of real time. So, for example, to join the quantum computing party is possible today, because it's just so early on. And you can literally acquire a smaller company and you're in the game as a country. But to join the cloud computing game today is just foolish.
There was a couple of stats I was thinking about as you guys were talking about this. I was listening to Tom Lee with Josh Brown a few months ago, and he was quoting a journal stat where they asked people in various countries and geographies if it was a good idea to start a business. And I think it was in like Europe and Japan. It was like literally, it was like only like 10% of people said it was a good idea. In the US, it was like 95%. I don't know if there's just something in the water, but if you just compare Europe to the US, I mean, venture capital tech investment is like a fifth in Europe. And there's certainly Silicon Valley Y Combinator models spreading around the world, but there's definitely something about the creative destruction that people are willing to do here.
Yeah, creative destruction is a really important component of any healthy economy. And I like to joke that the role of government is to find out what the citizenry is up to and put a stop to it. The U.S. does that a lot less than Europe or Japan. And thank goodness for that.
Yeah, it's super interesting to me. So again, Chatham House rule. I'm at a conference in DC. It's got policymakers, it's got senators, congresspeople, but there was a senior EU person in charge of regulation. And I put this point on the difference between innovation in the US and in the EU. That the US just seemed to be totally dominating and just no end in sight. And I actually hypothesized, the idea was that maybe the onerous regulations in the EU were actually impeding the innovation in the EU. So the regulatory environment is much stricter in Europe than in the US. And even though people in the US complain about the regulatory burden, it is still on a relative basis the Wild West, and very conducive to innovation. So this person responded kind of in an interesting way. And indeed, I linked this also to the difference in GDP growth in the US and the EU, where the EU is kind of stuck at like 1% is like a good number for them. For us, we're getting more used to 2%, which I don't like. We should be much more ambitious than that. But this person responded saying, well, we're just basically reflecting what the people want. And it is a trade-off of risk and expected return. So the idea is that they want a low-risk environment and they want to be protected. That's what the regulations are designed for. So it's almost like a cultural choice. So I do think that we need to take that into account. And indeed, today I saw this number that was striking to me, and it was analysis of the number of hours worked per week in various different countries. And we know the US is about 35 hours a week. And there's been like a negative trend for like over a century in terms of that number.
And that's going to continue with AI, just as an aside.
Yeah. But in Germany today, 25 hours a week. Think of that difference, 35 to 25. So again, I believe it's just different choices that are being made. And maybe it seems good right now, but in the future, you need to worry about a country or a block of countries that's not making the investments for the future.
Yeah.
Where will they be?
Most investors in Europe also are hugely underallocated to stocks. The culture of the individual there doesn't allocate to equities, which is arguably the premier compounding asset. And you have a situation where a lot of them, it tends to be real estate and cash.
Or government bonds yielding too.
Yeah. Interesting. Rob, you actually had, I thought, a pretty surprising paper to most people not too long ago, somewhat on this topic, where the role of government and spending in general. And I think the consensus narrative is that government spending stimulates economies, or when times are bad, like you need the government to come in and help. And you come out with you guys always have the best titles. Stimulus does not stimulate. You want to give us the broad overview of this paper and takeaway?
Sure. I mean, this is a very rich and fertile topic. As a business, we have no idea how to monetize it, but never mind that. It's a fascinating and fun topic. The neo-Keynesian worldview is forget about stimulus just during recessions. We should stimulate to revive animal spirits in the private sector and pull us out of recessions. And then let's continue to stimulate so that we take growth upon growth upon growth. All of this presumes that the spending in some fashion stimulates animal spirits and ignites growth. From a common sense perspective, every penny the government spends comes either out of taxes or borrowing. If it's out of taxes, it is siphoning money out of the private sector through government to spending, which chooses winners and losers. If it's out of borrowing, it's out of the private sector through government to pick winners and losers. So just as a libertarian, it just makes far more intuitive sense to me to believe that stimulus doesn't stimulate beyond time horizon measured in months, not years. So we ask the question, of course, on a rolling one-year basis. If you have higher spending, you're going to have slower growth, but the causality could be the other way, that the slower growth is stimulating the higher spending rather than the other way around. But if spending to stimulate growth doesn't pay off within 5 years, then we could argue the spending failed. And we went back historically over the last 60 years. There's two versions of the paper. You can search for stimulus doesn't stimulate, or you can search for a longer version that's on SSRN with a working title of Does Fiscal Stimulus Stimulate? It's a little less provocative title, but it's a deeper dive. And what we did was to go over the last 60 years and ask the simple question, when cross-sectionally do countries that spend more grow faster? Short answer is no, they don't. Not in any single 5-year span in the last 60 years. Not one 5-year span did the higher spending countries grow faster. In not a single 5-year span was the relationship statistically insignificant. It was significant in every single 5-year span. And intertemporally within countries that reduced spending saw growth increase. Ireland is a vivid, wonderful example of that. And countries that increased spending saw growth decrease. Japan was the dominant growth economy in the world in the 70s and 80s. Their spending was low. Their spending became high in the 90s and much higher after the turn of the millennium. And so now they're among the higher spending economies in the world. They were among the lower. They've gone from being leading into the 1990s, 60s, 70s, and 80s. They were growing 4.5% real per capita GDP growth per annum. This century today, that's been 0.7% per annum. Ireland is almost the reverse of that. Ireland was the poor country of Europe in the mid-80s. Their spending was 15% of GDP higher than the UK. It's now 15% of GDP lower than the UK. And they've become the prosperity and growth juggernaut of Western Europe since the global financial crisis. And let's not forget, Ireland was one of the hardest hit countries in the global financial crisis. Just horrific damage done. And yet, from 2008 to today, their per capita GDP is up 60%. The UK is up 10%, barely 0.5% a year. This is really striking evidence that spending doesn't work. Now, one of the key points we make in both papers, the short and the long version, is we're not arguing against government spending. We're arguing for a more intelligent dialogue. You mentioned in Europe that one of the key policy I lead in Europe said we're just responding to voter demand. People want stability. But are they presented with the full picture? Are they offered, we will spend more money on you? If government says, would you like us to spend more money on you? The go-to answer is, of course, yes, I'd love to. Please spend more money on me. If you frame it differently and say, if government spends more money, your children will not be as well off as they would be if we spend less now. So there's a trade-off. There's a sweet spot from about 15% of GDP to 30% of GDP where real per capita GDP growth is anywhere from 2 to 6% per annum. Now, pick the middle of that range, 4% per annum. That's enough to make our children twice as wealthy as we are, and then some. That's cool. If spending is above 45% of GDP, which is the European and Japanese norm, above 45% of GDP, real per capita GDP growth is in the 0 to 2 range. So take the midpoint of that, you're going to have to wait for your great-grandchildren to be twice as wealthy as you are. I'd rather have my kids be twice as wealthy as me and my grandkids to be 4 times as wealthy and my great-grandkids to be 8 times as wealthy than to have great-grandkids be merely twice as wealthy. And it's a choice. It's a conscious choice. The longer paper does a deeper dive and looks at alternative variables and asks the question, is this just proxying for something else like an aging population or a more prosperous economy that can't grow as fast but can spend more easily? And what we find is that the spending in and of itself stands up beautifully as a standalone variable in a multivariate context as one of 3 or 4 key drivers of how fast the economy can grow from the perspective of the individual citizen. It's a fun couple of papers.
Let me comment on a few things, and I definitely recommend that people read Rob's paper, which I've commented on. In my academic research, I've also looked at the cross-section of growth across different countries in the world and the sort of things that explain that growth. And I want to comment on the important point that Rob made about threshold. So if you think about like an emerging market, it's got very low government spending. So government to GDP is very small, but it's growing like crazy. And with that growth, some revenues arise that the government can actually use to build out productive things like infrastructure. So that's kind of the good government spending when you actually invest in infrastructure that allows businesses to actually grow in the future. So what we see is the share of government spending divided by GDP actually increases, but at the same time, these incredibly high growth rates, let's say above 10%, begin to revert to something more normal that we would expect to see in developed markets. So maybe the 5 or 4 or even 3% range. So it actually looks like there's a negative relation, but it's just a natural sort of process. The key thing in Rob's paper, I think, is where you go past the tipping point and you start to crowd out investment.
Yes.
And that's really dangerous. And I think that we're at or pretty near that point in the US right now. So think of our situation with $36 trillion in debt, where we've got a deficit of $1.9 trillion in a period where we've got decent economic growth, near record low unemployment, inflation with like a 2 handle, stock market near all-time high, yet we've got 1.9 trillion in deficit. That makes no sense. So 1.9, maybe I can understand in a crisis, like a serious crisis, like a war or something like that. But today, no. So that is a structural problem. It will cause crowding out. It will cause higher rates, which means less investment in the future. All of this will diminish economic growth. Indeed, we are in a bad situation where we need to borrow to pay the interest on the debt. So that never turns out well. So again, I think that this is a key point in Rob's paper where you're over that threshold, you start to negatively impact growth. And when you negatively impact growth, that means the revenues that are coming in to the government decrease. And we should be doing the opposite. So think about our situation. So our situation is that we need to pay down some of this debt. And there's 3 main options as to how to do that. So number 1, we increase taxes. And we all know that increasing taxes will decrease economic growth. So it's exactly what we don't want. Number 2, we could print money to pay off the debt. And the US could do that given that half the debt is owned outside of the US. So you just expropriate in doing that. But we know what happens when you print. You inflate. And inflation is just a tax. So we're back to kind of the number 1 point, that taxes actually decrease economic growth. So the third way is to keep the taxes as they are, but increase growth. So when you increase growth, the tax revenue actually increases. And we know that, yes, there's some efficiency things that we can do, but there's not enough to cut. We need to increase revenues. So this is why I think it's really important that the US be much more ambitious, that we should not be satisfied with 2% or 2.5% real GDP growth. There's no reason that we can't crank that up to 5. We've done that in the past, and we need to be encouraging innovation. We need to make it easier to start up a business. We need to make it easier to finance business. We need to have the number 1 objective is to grow. And that is a credible way out of our situation, which is, in my opinion, very serious right now.
I would agree. 2024, we crossed 2 very dangerous thresholds. There's what's been described as Ferguson's Law from Neil Ferguson, that countries that seek to be world leaders rarely remain world leaders once they start spending more on debt service than on defense. So that's one threshold that we crossed for the first time in U.S. history. We're spending more on debt service than on defense.
So debt service is the second largest spending category right now.
Yeah. The second threshold we crossed also last year was, for the first time in U.S. history, we could have taken all discretionary spending, including defense, to 0, and we'd still be running a deficit. I mean, that has never been seen before. And there's no tidy ways out of that mess. I'm also a big believer that what can't happen won't happen. Staying on this path over the coming decade can't happen, therefore it won't happen. How it breaks remains to be seen, but it almost requires a crisis before politicians are willing to do what's unpleasant and unwelcome in the electorate to bring things under control, which tacitly means that I think there's high odds of some sort of financial crisis in the coming decade. When it'll happen, I have no clue.
Unfortunately, in terms of the history of financial crises, government does the opposite.
The initial impact is the opposite, that's for sure.
But I think that it could be different the next time, mainly because we don't have any dry powder.
No. Credit default swaps in the U.S. are actually priced a little higher than they are for Italy or Greece right now. I don't know how many of your viewers are aware of that, but that's U.S. credit default swaps trading at a higher price than Italy or Greece, not by much, but higher. Good gracious, that's wild.
It is wild, and I will qualify this, that it is different from the U.S. So the U.S. is the reserve currency.
Yes, it is.
So I'm not sure about the pricing of those credit default swaps, but nevertheless, it does give you some pause, especially given that, the U.S. lost the final kind of AAA rating, but those credit default swaps are priced like BAA.
That's correct. That's exactly right. They aren't priced like single A. Well, should we leave it on that cheery note, or were there any other issues?
I was going to say, I was waiting for Doge to save us all. Gentlemen, I didn't get to ask Cam his GPT question, so I'm just going to reference it real quick. And Cam, I'm pretty sure you can guess what Chat GPT would ask you, because I think it's going to be the 40-year anniversary of your paper. But sure enough, GPT says, you've mentioned inverted yield curves, signal economic trouble, a view borne out of repeatedly, including in recent cycles, but given the post-COVID distortions and central bank interventions, do you still see the yield curve as a reliable recession indicator, or has this signal been corrupted by policy noise? Do you have any quick thoughts on that before we go?
Yeah, so really quick. This model that I proposed 40 years ago, a very simple model. There's not even like a Federal Reserve in this model. And all models eventually will be proved incorrect. I have not officially declared a false signal. We know that this model is 8 out of 8 in terms of predicting recessions with no false signals. And it could be a false signal, and maybe with high probability it's a false signal. So it's 8 out of 9. That's not bad. And I would certainly not discount it in the future. This has been a very reliable indicator. And to discount it for one observation, given the track record, that is fraught with risk.
Not to mention the fact that, as Meb was pointing out, this has been a cycle with arguably unprecedented central bank intervention in and trying to manage a yield curve, which is, I would argue, beyond their competence and beyond their actual ability to manage on anything beyond a short-term basis.
Well said. Well, we'll save that for next time, gentlemen. Thanks so much for joining us today.
This has been great fun. Thank you, as always, for the invitation.
I do appreciate the conversation. Thank you.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.